You're hearing it here first. The market has turned. Now it's just a matter of time for the data to catch up. Buyers, it's your market come the fall. Buyers, it's your world. We're all just living in it. In this video, we're going to go over the single-family condo markets in the state of Massachusetts. We're also going to do an interest rate update. And then, well, I'm going to open up a little in my opinion and what I'm really seeing. And I'll admit it, it's not pretty. Hi, I'm Jeff Chubb. I'm a recovering investment banker turned real estate agent, and I've sold more than 1,000 houses. If you have any questions in regards to the real estate market, then no, I am here to help. Now, I've been saying it for a couple of weeks now that the market is dead. And it was all seasonal. And that is true. But there is something different in the air, and its sellers really need to reset their expectations. It's now been 4 weeks of listing inventory being strong while buyer demand continues to be weak. And those couple of weeks are not factoring in the recent run in interest rates. It's a whole new world on the interest rate front. We're going to talk about that interest rates in a couple moments, so stay tuned. It's not a bad market by any stretch of the imagination. It's just changing. Homes, they're still going to sell, but it's going to take more time. The homes that are in the nicest condition, are priced right, will sell first. Then houses that are overpriced and aren't in good condition, well, they're going to sit. Pricing is going to be more important than ever. You're going to be tempted to get aggressive on pricing. Don't do it. But now, let's jump into the single-family market stats. We currently have 4,023 houses on the market. Did you catch that? This is the highest point that inventory has been all year long. We just jumped over the 4,012 mark unit that we reached on June 26th. And as we talked about in the last video, inventory is up because more sellers are coming on the market and buyer demand is waning. Has the Fed finally achieved their objective of crushing the real estate market? Look at the blue line making a dart towards 2011, 2022 inventory levels. It's an aggressive and impressive march forward. This is what I mean that the data isn't showing it yet. The inventory gaps have been shrinking for the last 4 weeks now. On August 1st, we had 1,855 fewer houses on the market. Then 1,574 units on August 8th. And then 1,381 fewer houses last week. And now 1,159 fewer houses this week as the same time last year. The difference between the all-time low is now 536 fewer homes on the market than it was back in 2021. No matter what metric you're looking at, inventory, it's growing. And it's because of a slowdown in buyer demand. We had 905 single-family homes come on the market this week. In the last 5 weeks, we've had 894 units, 899, 905, 919, and now back to 905. The tight range of new listing inventory, it continues. This week last year, there were 1,046 units that came on the market, and this means that we were 13.5% short of last year's levels. Now, the 4-week rolling average is 904 units, so the 905 units that came on the market, well, it's right on average. We had 842 single-family homes go under agreement last week. Now, this is compared to the 1,179 units that went under agreement this week last year, which means under agreements are off by 28.6%. Did you notice that the graph shows how the red line is remaining below the blue line for the last 3 weeks? That's the waning buyer demand that I've been talking about. That is 3 weeks in a row where buyer demand has never been more than seller supply. 2 weeks ago, there was a 9% difference between new listings and under agreements. This week and last week, that difference went up to 15% for each of those weeks. And with interest rates making a jump, I don't see this trend. It's not going to change anytime soon. Now, the 4-week rolling average is 899 units, so under agreements are continuing to come in below that average. There were 787 single-family homes that closed last week for an average sales price of $795,000 and a median sales price of $630,000. Months of inventory, this is how we determine what type of market we're in. 0 to 5 months, that's considered a seller's market. With the closer you get to 0, the more aggressive of a seller's market it is. Now, this week, months of inventory continue to grow to 1.35 months compared to last week's 1.31 months. This continues to indicate that it's a strong seller's market, but the months of inventory are increasing. Now, real quick, here's my shameless plug. I just wanted to mention that if you are thinking about buying or selling a home, then it would be a true pleasure to help. Now, onto the condo market. We have 2,181 condos on the market as of Monday. This is compared to last week's 2,184 units, or 2 weeks ago when we had 2,195 units on the market. For all intents and purposes, condo inventory, it's unchanged. Very different from what's going on in the single-family market. But when comparing inventory levels today to 28 days ago, inventory has now gone down by 1.5%. This is compared to what we saw in the single-family market, where inventory is actually up by 7% in the last 28 days. We currently have 295 fewer condo units on the market today than we did today last year. This means that inventory is only off by 11.9% compared to the same time last year when there were 2,645 condos for sale. On August 1st, we had 611 unit difference than last year. Then we had a 448 unit difference with 358 units last week and now 295 units fewer than the same time last year. What's interesting is that, as I said earlier, inventory, it's not going up. It's steady. It's just that the last year in 2021, the inventory levels were decreasing. There were 371 condos that came on the market this week. The 4-week rolling average is 396 units, so we're coming in line with that average. But check this out. We listed 380 condos this week last year. This means that we were only off by 9 units or 2.4% compared to the same time last year. This is now the third week in a row that we were right at the listing levels of the previous year. 3 weeks ago, we were 7 units shy. Last week, we actually listed 22 more condos than last year on the market, and now we're just 9 units shy. That's kind of crazy. It happened fast. There were 336 condos that went under agreement this week, while the 4-week rolling average is 375 units. So we're a considerable amount below that average. When compared to the same time last year, there were 336 condos that went under agreement. This means that the amount of condos that went under agreement were off by 12.3%. So inventory was off by 2% compared to last year's numbers, while pendings were down by 12%. There were 307 condos that sold this week for an average sales price of $697,000 and a median sales price of $552,000. And then that months of inventory, it increased to 1.63 months from last week's 1.61 months. Do you like hearing about what's going on in the Massachusetts real estate market? Then can you do me a huge favor? Can you hit that like button as it helps with that YouTube algorithm? It makes a huge difference on my channel. And while subscribing, that one doesn't hurt either. So hit that subscribe button. All right, let's do it. Let's talk about interest rates. And apologies in advance if you see some tears rolling down my face, because it was a tough week. Actually, that was an understatement. Interest rates have continued their march up. MortgageNewsDaily.com is showing a 1/4 point increase in the last week and now a 1/2 point in the last month. And it looks like our predictions back at the beginning of July about interest rates being in the 8% range in the fall, well, they were correct. Oh, you missed that video. Well, then you should definitely take a look. I'll say that one thing stood out to me on this graph. Even with the very quick escalating interest rates, we are only 1.88% higher than we were this time last year. Don't get me wrong, nearly 2% is a lot, but I kind of forgot at this point last year we were quickly approaching 6%. When you look at this chart for last year, don't get me wrong again, there are a bunch of ups and downs, but it's relatively level. But there's no hiding it. Buyer affordability continues to erode, and sellers should take notice and be on the lookout for Saturday's video, because Sammy and I, well, we talk about where we believe interest rates are headed, and we disagree, with one of us seeing a scenario where we could break in the 10% mark. Now, I tried to find another topic, an article to talk about, but nothing was really mirroring how I felt and what I was seeing in the market. So here's a little from the heart. It makes me think of the old Wear Sunscreen songs.
Ladies and gentlemen of the class of 99, wear sunscreen. If I could offer you only one tip for the future, sunscreen would be it.
So to that point, wear sunscreen. If I could offer you one tip for the future, sunscreen would be it. The long-term benefits of sunscreen have been proved by scientists, whereas the rest of my advice has no basis more reliable than my own meandering experience. Man, I love that song. Still listen to it every once in a while today, as a matter of fact. My thoughts. We're in for some hard times. There's not going to be a soft landing. In order to get back to average, you can't just slow down. You need to hit the brake. And depending how fast we were going, you need to hit it hard. Imagine going 130 miles an hour on the highway. If you need to get down to the speed limit of 65, if you keep your foot on the accelerator but decrease the pressure, then you'll start to slow down. But it's going to take you quite a while to get to 65. That's what the Fed's doing right now. But hit the brake, and now we'll get to 65 a lot quicker. As an economy, we need to get inflation down to the 2% level. We need to get down to 65 miles an hour. In order to do that, the pendulum, it needs to swing hard the other way. We experienced great financial gains during COVID from the $10 trillion the government printed. But now it's time for us, well, you and me, the people on Main Street, to pay the bill. It's like everyone got up from the table and left us just sitting here, holding your credit card, just hoping the charge is going to go through. Real wages, they're decreasing. Savings are being eroded. And from what I can tell, inflation's about to come back, and it's going to get worse. How do I know that? Or better yet, why do I think that? Because that's what history says. Plus, the people who believe they are our betters, well, they haven't gotten serious about the problem. Go back and look at the 70s. 1974, inflation was 11%, and then 9% in 75, and 76 coming in at 5%. People were celebrating. They won! Kind of like what we're hearing today. The fight's over. The Fed will soon be able to start cutting rates. But in 1976, inflation started to climb to 6%. Inflation would continue this climb till 1980 when it hit 13.5%. As long as the government keeps their course of printing an absurd amount of money, then you and I, we're going to continue to pay that bill. And that bill is paid by lowering living standards with decreased real wages and negative savings rates. So I guess, what's my opinion? Where can you hide, if you will? The answer is in real assets, gold, and real estate. Home values climbed every year in those high inflationary environments. Makes sense. The value of the dollar decreases, so therefore the cost of the good or service and assets increases. And yes, I am a guy that actually puts my money where my mouth is. That's why I'm starting a real estate investment arm this fall to buy houses. Because in my opinion, it's the best hedge for a drunken government. But go and do the research yourself. Compare. Gold had a crazy run in the 1970s. It went from $97.32 an ounce in 1973 to $614.80 an ounce in 1980. That is a pretty sweet 532% return in 7 years. Compare that to the Dow Jones Industrial closing at 850.36 points on the last day of 1973. On December 31st of 1980, it closed at 963.99 points. That's a sweet 13.4% increase over those same 7 years. Oh, and during that time, inflation rose by 71%. It would actually be more if you calculated it off by real dollar buying power. But in this case, I just added up the inflation levels for each year. So going off this lower value metric, then that means that someone in the stock market lost 57.6% of their real dollar value. And by the way, I really hope I'm wrong about our ship heading towards this huge iceberg. I lived through 2008. I don't need another historical economic event in my lifetime. But for real, wear sunscreen. It's been proven to make a difference. Want to talk about your own personal real estate needs? Whether you're looking to buy in the next 9 or 90 days, then I would love to chat with you and just find out more about your real estate goals. And if you're thinking about possibly selling, then we can help you traditionally or even offer you a cash offer on your house for a seamless and stress-free sales process. No matter what your situation, we can help you get it done. You can also visit us at youtuberealestateagent.com and just fill in your information, and then we're going to reach out to you. Questions or comments about the market data? Well, then drop me a line in that comment section below. You take the time to watch the video, so I'm always going to take the time to respond to you. Until next time.